Wall Street is pumping AI stocks. Every big bank has a buy rating on them. And at the exact same time, those stocks are falling apart. One company that has been around for over 100 years just had the single worst trading day in its entire history, worse than 1987, worse than the dot-com crash, worse than 2008, worse than COVID, and it happened in the middle of what everyone is calling the greatest technology boom of our lifetime. I've lived through 5 or 6 of these cycles now, and I want to tell you something that took me decades and a lot of painful losses to understand. When the people who are supposed to be the experts are the loudest cheerleaders in the room, that is not a signal to relax. That is usually the signal to pay very close attention, because I'm going to show you exactly why Wall Street can be shouting buy with one hand while quietly moving their own money with the other. And once you see this pattern, you will never look at a stock recommendation the same way again. Before I go further, I want to say something plainly. What I am about to teach you took me most of my working life to learn, and a lot of it I learned the hard way, by losing money. I am putting it here for free in one place, because I think everyone deserves to understand how this machine actually works before it affects their savings, not after. All I ask is that if this is useful to you, you subscribe to this channel so more of this reaches more people before the next mistake gets made. That is the only price. Now, let's get into it. Let's start with something that sounds boring but explains almost everything. Who is actually paying the people telling you what to buy? When a bank puts out a research report with a price target, most people assume that is an independent, objective forecast. It is not, and it was never fully independent, not even after the reforms. Here is how the incentive really works. The same banks that publish glowing reports on a stock are very often the same banks trying to win the job of raising money for that company, arranging its debt, running its stock offerings. That work can be worth hundreds of millions, sometimes billions in fees. So ask yourself a simple question. If you are an analyst at one of these banks and you know your firm wants to win the next deal from a company, how likely are you to publish a report saying that company is overvalued and risky? You would probably not keep your job very long. This is not a conspiracy theory. It is just basic incentives. And I've spent my whole career trying to understand incentives, because incentives explain almost all human behavior better than intentions do. After the dot-com bubble popped in the early 2000s, regulators found actual proof of this. Internal messages showed analysts privately calling stocks garbage while publicly slapping a buy rating on them, because their firm did not want to upset a client. One internal email that later became public said something close to this: "We are losing people money and we do not like it, but we do not want an investment banking client to be upset with us." Think about what that really means. Someone inside the firm knew in writing that ordinary families were losing money so the bank could protect a relationship worth a few $1,000,000 in fees. That analyst got fined and banned from the industry for life over it. So regulators built a wall. They forced research departments and investment banking departments to operate separately, with rules about how much they could even talk to each other, sometimes requiring a chaperone in the room if they did. That wall was one of the few real protections ordinary investors had. And here is the part that should get your full attention. That wall was quietly taken down not long ago. The rule that kept research honest was rolled back right as the biggest hype cycle since the dot-com era was reaching its peak. So think about the timing. The referee gets pulled off the field. And right after that, you start seeing price targets on AI-related companies that imply valuations of $10 trillion. Valuations at levels representing hundreds of times a company's sales levels. Nothing in the history of markets has ever sustained for long. Nothing on earth. Not the fastest growing company in history trades at those multiples for good reason. When you see numbers that extreme, dressed up in language that sounds more like a movie trailer than a financial report, calling a company the peak of human ambition or the next frontier of civilization, that is usually not analysis anymore. That is marketing wearing the costume of analysis. I have read thousands of research reports over my career, and serious analysis does not usually need poetry. When the language gets that emotional, it is almost always compensating for something the numbers cannot justify on their own. And once you can tell the difference between real analysis and a sales pitch, wearing a suit, you can protect yourself from a huge amount of bad decision making, not just in this cycle, but in every cycle that comes after it. Now, let me show you something that is not theory. This is happening right now in real numbers. A company older than the Great Depression, one that survived a world war, the rise of the personal computer, the internet, the 2008 crash, and every recession in between, just posted the single worst day in its 100+ year history, down around a quarter of its value in one trading session. The instinct is to assume this old company simply got left behind by newer, faster AI competitors. The classic story of the dinosaur getting eaten, but that is not actually what happened. And this is the part I want you to really absorb because it flips the whole story on its head. This company did not fall because it missed the AI boom. It fell because of the AI boom. Its own customers, big corporations, took the budgets they normally spend on regular software and computing and redirected that money toward AI chips and AI data centers instead. Management even had a polite phrase for it, something like reallocating spending. Translated into plain English, their customers pulled money out of one part of the economy to feed a shinier, newer part of the economy. This is one of the clearest signs of a late-stage boom that I know of. In a healthy expansion, new investment adds to the pie. Everybody grows together. The new technology lifts up the old economy alongside it. But when a boom becomes so hungry that it has to cannibalize healthy, profitable, well-established businesses just to keep feeding itself, that is not early-stage growth anymore. That is a system consuming its own foundation to stay alive a little longer. Think of it like a family that starts skipping the mortgage payment to buy a flasher car. For a little while, it looks like they are doing great, driving around in something impressive, but you have not actually created new wealth. You have just moved money from one place you need it to another place that looks more exciting, and eventually the mortgage bill still comes due. And it did not stop with one company. Other major technology and software firms got dragged down the same day in sympathy because the market suddenly understood something important. If companies are starving their normal spending to fund AI, that is a warning sign for a much wider slice of the stock market than most people realize, including the parts of your portfolio you assume are safe. This is exactly the kind of connection most people miss because they watch stocks as if each one exists in its own separate bubble. No pun intended. They do not. Money is one interconnected system, and when it gets ripped violently out of one part of that system to feed another, the shockwaves travel much further than the original headline. If you own an index fund, if you have a retirement account, a huge amount of this exposure is probably already sitting inside your accounts without you ever having chosen it directly. It got put there because that is simply where the money has been flowing, and most retirement accounts today are more concentrated in a small handful of technology names than at almost any point in modern market history. So now you might be asking, where is all this money actually coming from? Because none of this is being funded out of profits. It is being funded with debt, real borrowed money, at a scale most people do not appreciate. In just the last couple of months, companies building out AI infrastructure issued well over $100 billion in brand new debt. AI-related borrowing now makes up a meaningful chunk of the entire corporate debt market in the country. These companies are essentially betting the house that future revenue will show up fast enough and big enough to cover what they are borrowing today. I have studied debt cycles for most of my career, and one thing is always true across every cycle in history. Borrowing pulls spending forward from the future. When you borrow, you are essentially taking spending power from your future self and using it today. It feels like free growth. Today, the data centers get built, the chips get bought, the headlines get written about how strong the industry looks, but that spending always has to be paid back later with interest, usually at the worst possible moment when confidence is already fading and revenue has not caught up to the promises that were made to lenders. This is the same basic pattern behind almost every major bubble I have studied. Going back 100 years, technology changes, the specific companies change, the underlying mechanics of borrowing against an optimistic future almost never do. And there is a second trick layered on top of the debt, one that is even harder to spot if you are not looking for it. And once you see it, you cannot unsee it. A large chip maker invests billions of dollars into a smaller AI company. On the surface, that looks generous, like they are building the ecosystem together, helping a promising young company get off the ground. But then that smaller company turns around and uses a big chunk of that same money to buy chips from the very company that just funded it. The chip maker then books that purchase as revenue. Revenue goes up, the stock price reacts, and investors cheer, assuming real organic demand from the outside world is driving it. But if you follow the actual dollar bill, it left the chip maker's pocket, traveled to the smaller company, and came right back to the chip maker as a sale. It is the same dollar taking a lap around the room, dressed up to look like brand new demand every single time it passes through. So you can run that loop over and over, funding one company after another this way. And from the outside, the revenue numbers for the whole industry look fantastic, growing every quarter, beating expectations. From the inside, very little genuinely new economic value is actually being created because the money never really left the building. It is estimated that a very large share of reported AI revenue today traces back to this kind of circular arrangement in one form or another. When a meaningful share of an industry's reported growth depends on money simply moving in a circle between a small handful of related companies. That tells you the underlying demand from real paying customers out in the world is not nearly as strong as the headlines suggest. And that gap between the story and the reality is exactly the kind of thing that eventually has to close. Here is something I've learned that matters more than almost anything else when you're trying to understand markets. Pay far more attention to what people do with their own money than to what they say publicly. Words are cheap. Positioning real capital is not. This is what I mean when I talk about there being two different versions of Wall Street operating at the same time under the exact same roof. There is the version you see on television and in glossy research reports, full of confident price targets and phrases about how technology is going to change all of civilization. That version's job is to keep deals flowing and keep the public buying, because that is literally how that side of the business gets paid. Then there is the version you almost never see, sitting on the trading desks a few floors away in the same building under the same company logo, moving the firm's actual money based on what they genuinely expect to happen, not what sounds good in a headline. Those two versions do not always agree with each other. And when they disagree, that disagreement tells you something important, because one of those two groups has real skin in the game and the other one does not. I built my entire career around trying to close that gap, trying to understand what the smartest, most well-informed money is actually doing, not what the general public is being told to believe. It is one of the single most useful habits you can build as an investor. Whenever you hear a confident public prediction, ask yourself a simple follow-up question. Is the person saying this also putting their own money behind it in the same size and the same direction? If the answer is no, or if you cannot easily find out, treat the prediction with real caution, no matter how many headlines it generates or how confident the person delivering it sounds on camera. There was a recent, very clean example of this. A respected financial newspaper reported that major banks were quietly trying to offload risky AI-related debt off their own books, essentially trying to hand that risk to someone else before trouble hit. Within about 48 hours of that report, one of those same banks published a big, confident, optimistic note about the AI trade, telling the public the future looked bright and to stay invested. And around that same window, people close to that bank's own trading desk, the ones moving real money in those exact bonds, describe what was actually happening in one blunt word: carnage. So publicly reassurance, privately, quietly dumping risk, same firm, same week, two completely different messages depending on whether they were talking to you or talking to their own balance sheet. This is not some rare conspiracy. It is simply how these incentives have always worked, and the guardrails that used to limit it have gotten weaker at exactly the wrong time. Now, let me zoom out, because I think this is the most valuable thing I can offer you. Context. I have spent decades studying how economies and markets move in cycles, going back hundreds of years across many different countries. And one pattern shows up again and again across very different eras and very different technologies. New technology arrives that is genuinely transformative. Railroads were transformative, and they still went through a brutal boom and bust. The internet was transformative, and it still produced one of the most painful crashes in modern history. AI is transformative too, And I want to be very clear about that because none of what I am saying here is an argument against the technology itself. I use it. Businesses I'm involved with use it. It is remarkable. The problem has never been technology. The problem is what human psychology and financial incentives always do around genuinely exciting new technology without fail. Every single time, here is the template, almost step by step. Money floods in faster than the real economic value can be built to support it. Borrowing accelerates because low rates or easy credit make it feel free. Storytelling replaces analysis because a good story is more exciting to repeat than a spreadsheet. Prices get pushed to levels that quietly assume everything goes perfectly for decades into the future with no competition, no setbacks, no surprises, and normal, healthy skepticism gets treated as if it were foolish or old-fashioned, as if the person raising questions simply does not understand how different this time is. I've heard this time is different in every single cycle of my life. It was said about the internet. It was about housing before 2008. It is being said about AI right now. Every single time this pattern has played out across history, it has eventually been corrected, sometimes gently, sometimes violently, but it always corrects because reality always catches up with the story eventually. The technology usually survives and often thrives for decades afterward. It is the prices, the leverage, and the people who bought in at the very top who do not. The uncomfortable truth is that when this correction comes, it rarely sends you a polite warning in advance. Most people find out the same way every single time they log into their account one day and see it down 10, 20, 30%, and there is very little useful action left to take at that point. I have watched good, careful people live through this before in earlier cycles. People who did everything reasonably right and still got seriously hurt because they did not understand where they stood in the cycle. That is really the whole point of studying this stuff as closely as I have. You cannot reliably predict the exact day a bubble bursts. Nobody can do that with real precision. And anyone who claims they can is not being honest with you. But you absolutely can learn to recognize the stage of the cycle you are in, and you can adjust your own decisions accordingly well before the crowd figures it out. So here is my challenge to you. Do not just watch this and move on to the next video like it was pure entertainment. Go look at your own accounts this week. Actually open them up and look. Find out how much of your retirement money, your index funds, your investments are actually tied to this AI trade, because the honest answer for most people is going to be more than they think. You did not necessarily choose that exposure directly. It built up around you while the story was exciting and the headlines were loud and everyone around you seemed to be making easy money. Understanding where you actually stand is not pessimism, and it is not betting against a technology I genuinely respect and use myself. It is simply refusing to be the last person in the room to find out what smart money already quietly knows and has likely already acted on. I did not build my career by being the smartest person predicting the future. Nobody can consistently do that. And anyone telling you otherwise is selling you something. I built it by trying again and again to understand where we actually stood in the cycle, and by respecting the fact that I could always be wrong. So I never bet everything on being right, That habit of mind is worth more than any single stock pick you will ever hear about on television. Take what I taught you today about incentives, about circular money, about listening to what people actually do with their own capital rather than what they say on camera, and use it like a lens the next time you look at your own portfolio. Subscribe to this channel so you catch the next piece of this before it matters rather than after. Share this with one person you know who is heavily invested in tech or who has been feeling a quiet, nagging sense that something about this boom does not quite add up. And go check your own accounts today, not after the headlines eventually force you to.